This video is for educational purposes only and is not professional financial advice. Do your own research before investing. Micron Technology, ticker MU. 46 years in the semiconductor business, and right now this company is doing something that should stop you in your tracks. Revenue growth accelerating, not just growing, accelerating, to a rate that most established companies never see even once. The question this video is built around is simple but sharp. Is Micron actually capturing the massive memory and storage market that's opening up in front of it, and is the stock market pricing that correctly? We're going to work through the full picture, the size of the opportunity, the growth trajectory, what makes this business defensible, whether the unit economics hold up at scale, and whether the current valuation is a gift or a trap. By the end, you'll have a real point of view, not just a list of facts. Let's build the argument. Here's the backdrop for everything Micron is doing. The semiconductor market, the total pool of revenue this industry competes for, is enormous and still expanding. SkyQuest estimates the global semiconductor market reaches $603.61 billion by 2033. Fortune Business Insights puts it at $447.93 billion by 2034. Two different methodologies, two different endpoints, but the directional agreement is clear. This is a multi-hundred-billion-dollar market, and it's growing. Now, Micron doesn't play in all of semiconductors. It's specifically in memory and storage, which is arguably the most AI-sensitive corner of that market. Every AI model, every data center build-out, every edge device needs more memory. That's not a coincidence for Micron. That's a structural tailwind. The real question isn't whether the market is big. It obviously is. The question is whether Micron is actually capturing a growing share of it, or just riding the wave while it lasts. That's exactly what the growth data is going to tell us. This is where Micron's story gets genuinely exciting, and I want to be honest that this surprised me when I dug into it. The flywheel isn't just spinning, it's spinning faster every quarter. Look at the trajectory. Back in the down cycle, fiscal 2023, Micron was posting year-over-year declines of 47%, 53%, even 57% at the trough. Brutal. But then the recovery came, and it didn't just recover, it accelerated. 15.7% growth in the first quarter of 2024, then 57.7%, then 81.5%, then 93.3%, and it kept climbing. The most recent numbers are almost hard to read without double-checking them. Year-over-year revenue growth of 196.3%, then 345.7%. That's not a rounding error. That's a business that's restructured itself into a completely different growth orbit. On the product side, DRAM is the engine, generating $28.58 billion in revenue, with NAND contributing $8.5 billion. Geographically, the United States alone accounts for $24.11 billion, a dominant home market anchor. Taiwan adds another $5.67 billion. The acceleration signal here is real. The question now is whether the business model can sustain it. That acceleration we just traced through the growth data, can the business actually support it structurally? That's the Moat question, and the scorecard on screen gives us a credible answer. Start with gross margin at 39.8%, and the trend is expanding. That matters more than the level alone. When a company is scaling this fast and margins are moving up, not getting squeezed, that's pricing power. That's not a commodity trap. That's a business with real leverage in its customer relationships. The Rule of 40 score is 53. For context, the Rule of 40 adds revenue growth rate and profit margin. Anything above 40 is considered healthy for a growth company. Micron is comfortably above that benchmark, which tells you the growth isn't being bought with reckless spending. The business is growing and profitable in a way that compounds rather than dilutes. Free cash flow is positive. No cash burn. The company is generating real money as it scales, not promising future profitability while burning through reserves today. Now look at the revenue momentum chart. The last 8 quarters of revenue bars show a consistent staircase upward, with the year-over-year labels climbing alongside. This isn't a one-quarter spike. The demand durability is visible in the pattern. Verdict: Micron's Moat isn't just a manufacturing position. It's an expanding margin, cash-generating business model that's proving it can grow without breaking. That's structural durability. The scorecard we walked through told us the business is healthy at a high level. The unit economics tell us whether that health is real or cosmetic. Gross margin peaked at 45.2% in 2022, collapsed to negative 9.1% in 2023 during the memory down cycle. That's not a typo. The company posted negative gross margins at the trough, and has since recovered to 39.8% in 2025, with the direction firmly expanding. The margin trend expanding by 2.2 percentage points over 5 years through one of the sharpest industry downturns in recent memory is a meaningful signal about the resilience of the business model. The Rule of 40 score of 53.3 reinforces this. Growth and profitability are moving together, not trading off against each other. That's the sign of a business that's found its operating rhythm. On operational leverage, Micron has 48,000 employees and trailing revenue running well into the tens of billions of dollars. That revenue per employee ratio reflects a capital-intensive but highly productive workforce, and the momentum in revenue suggests the company is generating significantly more output per person as scale increases. That brings us to valuation context. The current price-to-sales ratio is 3.6 times, with an enterprise value to revenue of 7.7 times. Given the growth rate and expanding margins we've just walked through, is the market paying a fair price? That's exactly what Scene 6 is going to answer. Let's price this thing honestly. The PS ratio history panel shows Micron's price-to-sales multiple over the last 4 years. 3.0 times in September 2021, falling to 2.1 times in 2022 during the down cycle, spiking to 4.9 times in 2023 as the recovery was anticipated, pulling back to 4.2 times in 2024, and sitting at 3.6 times today. The current multiple is actually near the low end of its own 5-year range, not stretched by historical standards, despite the growth rate being far higher than it was during any of those prior periods. Now look at the valuation meter. The PS to growth ratio is 0.01 times. Here's what that means in plain English. You're paying less than 1 cent in price to sales for every percentage point of annual revenue growth. When that ratio is below 1, the market is paying less than 1 times each percentage point of growth, a signal of undervaluation relative to growth velocity. At 0.01 times, the meter needle is deep into cheap relative to growth. The analyst grades panel confirms the direction. 57 buy ratings, 11 holds, just 2 sells. The consensus is buy, and that aligns with what the PS to growth math implies. The analyst price targets panel frames the upside concretely. The lowest individual analyst target is $1,100. The average of all analyst targets, the mean, is $1,569.09. The highest individual target is $2,200. Against the current price of $979.30, the average analyst target implies upside of approximately 60%. Nothing about Micron's growth story is risk-free. Here's what deserves real attention. First, multiple compression. Micron is priced as a growth stock, and growth stocks are rate-sensitive. If interest rates stay elevated or sentiment shifts away from semiconductor names, even a company growing at 345% can see its multiple contract sharply. The stock's 52-week range, from $103.38 all the way to $1,255, tells you exactly how violently this name can move. Second, competitive disruption. Memory and storage is a market where Samsung, SK Hynix, and increasingly well-funded Chinese manufacturers compete directly. A technology misstep or aggressive competitor pricing could pressure Micron's expanding margins faster than the revenue growth can compensate. Third, cyclicality. Remember that negative 9.1% gross margin in 2023? Memory markets have deep cycles, and the current acceleration could attract oversupply that resets pricing. It's happened before. Now the catalysts. AI infrastructure build-out is the most direct one. Every major hyperscaler expanding data center capacity needs more high-bandwidth memory, and Micron is a key supplier. The shift to HBM, high-bandwidth memory for AI accelerators, is a product mix upgrade that carries premium pricing. And finally, geographic diversification. As the U.S. revenue base dominates, any recovery in Asian enterprise demand adds an additional layer of upside. Here's where I land after working through all of this. Micron is a company with 346% revenue growth, expanding gross margins, a Rule of 40 score of 53, positive free cash flow, and a price-to-sales ratio sitting near the low end of its own 5-year history. The market right now appears to be underpricing the velocity. The bull case, AI infrastructure spending, is a multi-year build-out. Micron is a critical supplier, and the average analyst target implies roughly 60% upside from today's price. The bear case, memory markets cycle hard and fast, and competition from well-capitalized rivals could compress the margins we just spent 2 scenes praising. Weighing those against each other, with the growth accelerating rather than plateauing and the valuation meter pointing firmly at cheap relative to growth, this is a strong growth buy. Not a speculation, not a hope. A data-supported conviction. Do your own diligence, size it appropriately for your risk tolerance, but don't ignore what these numbers are saying. Subscribe so you don't miss the next one.